Welcome back to the Retire in BC podcast. I'm Ben, and today we're tackling a topic that affects people at every stage of life: debt, especially high interest debt like credit cards and unsecured loans. Debt can feel overwhelming, stressful, and sometimes even embarrassing, but it doesn't have to be permanent. There are some clear steps, real options, and in many cases, a path forward that doesn't involve starting from scratch. Today, Arnold and I are going to walk through those options, from simple budgeting strategies all the way to more formal solutions like consumer proposals and bankruptcy, so that you can understand what's available and what might make sense for your situation.
Hey Ben, before we talk about all of that stuff, can we kind of reframe debt? Because I don't want people to think it's all bad. And in fact, I love debt.
Definitely, yeah.
And I recognize I'm a bit of a unicorn, but uh, uh, it, debt has made me wealthy. And actually, I think it's made a lot of our listeners wealthy. Like most of us, our first debt, our first big debt was our mortgage. We bought a house, and at least for my older clients, that's often been their best investment. Not because it was a great investment, but because they borrowed money to buy it. And so it just, they made more than the interest was. So debt's not always a bad thing. Lots of debt is good debt. Mortgage debt, if it's a good house, business debt, if it's a good business or good investment. Borrowing money maybe for your education, just depends on the education, might be a good thing to do. But I love debt. It's just high interest debt is a big problem, especially if it's high interest debt for bad things like just regular living, right?
Yeah, well, and I'd encourage our listeners to maybe just double check on our last episode that we did on the power of compound growth. And we talked about how the more you earn and the longer you let it earn for, the more that kind of compounds in your favor. And we talked about high interest debt working against you. Really, any interest works against you, but if you're able to borrow it, let's say 3%, and invest in something that earns 8%, you're right, it can be a very powerful, useful tool for you. It is really those higher interest loans. If you've got a personal loan at 9% or worse, a credit card debt paying 20 or 22% interest, that's a really huge problem that really compounds against you very fast. And even in the short term, it can be pretty painful to get out of that. So you're right, really trying to normalize it, to frame it a little bit. Lots of Canadians have some form of debt. If you're using that debt to buy a productive asset or something that's likely to continue to grow faster than the debt, maybe it's not so bad. But like you say, if it's just to fund your lifestyle, if you're borrowing money to go out this Friday, well, maybe that's not the right call.
Yeah, absolutely. And I guess we want to maybe also remove any shame from this conversation. Um, People get into debt problems for lots of reasons. Sometimes it creeps up on you. I guess probably it creeps up on you, but you know, different life events, housing costs, family needs, health issues, job changes, they're not always in your control. So there's lots of reasons that you can get into debt problems. We don't want anybody to feel bad about that. What we want to do is help people get out of them.
Yeah, yeah. Well, and the goal is to not just kind of push one solution as the way to get out of debt. It's not to scare people or anything like that. Really, it's just to explain what's going on and what are the options out there. And there's kind of a bit of a scale of how severe of a solution you need to get out of the debt problem. But yeah, no, I think that's a very helpful reframing for it.
Yeah, yeah. Well, so I guess the first step is you got to find out what you owe, to list all of your debts. And frankly, we developed a decent tool for this. If you want to copy that, fire an email off to us. But it's pretty simple. It's not a real complicated tool. We just have a number of columns. The first, and I'll just outline all of the columns. So if you want to create this tool for yourself or listeners, feel free. But first column is just what the institute. Is it held at RBC or Scotia or MBNA or wherever? List that name. The second is the type. Is it a credit card or a line of credit or a mortgage or consumer debt? Then the third amount is the amount, or the third column is the amount currently owed. How much do you owe right now on that, whatever debt instrument it is? The next column is if it's a revolving credit facility, like a line of credit, something, or a credit card, something that you can increase. What's the maximum credit limit? And there's a reason for that is if it happens to be a low interest thing, there may be an opportunity there for you to use that facility and borrow more against that to pay off something that's a higher interest rate, right? So just to have that information. Then the next column is the interest rate. The next column is the minimum monthly payment. Because, for example, on a credit card, you may the actual interest cost may not be um, or the sorry, the interest cost is high, but the amount that you have to pay may be significantly higher. And again, you want to know that. Um, I added in a column that a lot of advisors don't add, or credit counselors don't add, but I added in a column that says just binary, is this a tax deductible debt or not? Because frankly, if you owe money at 6%, if you have two loans, one at 6% and another one at 6%, but one of them is tax deductible, the after-tax cost on that is probably only about 4%. Depends on what your tax bracket is. Maybe that should have been another column. It's not one of the columns. And then finally, just one for notes. What's the collateral? What are any additional comments? And by listing every single one of your debts on there, you're going to get some clarity as to what each one of them are.
Yeah, well, exactly. Listing it out gives you some visibility into what you owe and what all the different moving parts are. And so, whether you're trying to do this yourself or whether you're going to fill this out and take it to your financial advisor or a credit counselor or something, it's just they need that info in order to be able to help move things around. Even if you're not currently using a piece of debt, like Arnold said, like if you have zero balance owing, but you
Good,
have
good point.
5,000
Yeah.
available on a line of credit, like that's something that's helpful to know in order to move some money around. And then you can kind of decide based on there what makes the most sense. I think kind of the first option is to just to come up with a budget for yourself and try to pay down those debts as aggressively as you can. Um, there are kind of two schools of thought on this, and I think both are valid. One is what's called the snowball method, which is just whichever one's your smallest debt, take care of that first. Get rid of it. You get some psychological momentum going. You delete one thing off of your to-do list. You free up some cash flow. So it's just really a good way of kind of getting that out of the way and dealing with them one at a time. On the other hand, if you've just dealt with the smallest one first, well, maybe that wasn't at the highest interest rate. Maybe it was a lower interest rate. And so the second school of thought would be, you know what, we should really do it's called the avalanche method, but just whatever the highest interest rate is, that's the one you want to put the most money behind and really pay that down as fast as possible. From a mathematical standpoint, that's kind of the correct way, or will get you out of debt faster, but again, then you're maybe not hitting those psychological wins or freeing up quite as much cash flow quite as fast. But I just think like those small wins, they can matter for some people, or for a lot of people. Like even just freeing up an extra $100 a month to then continue accelerating and paying down the next loan, that can be a pretty big win and reduce your total interest paid.
Well, and actually, I can speak to that personally. Before I was in this business, my first house, I bought with nothing down. And so I ended up with, I had a first mortgage. BC at the time was offering some sort of special deal on second mortgages. So I had a BC second mortgage. And then I had to get a loan against my car to, uh, for part of the money, and the seller took over some of the debt. That's how I managed to do it, nothing down. So that was four loans. Um, oh, and then I owed a little bit of money to family, because we had done some renovations on the place and ran out of money, and family helped out. So we had five loans here going, right? And so this tool that I just mentioned, it actually came out of that, because I that's exactly what I did to help me. We I wouldn't say we were having debt problems, but I felt like we had too much debt and it was bothering me, and I wanted to figure out the best possible way to deal with it. And so that's exactly what I did. Now, in that particular case, we had a zero interest loan that we chose to pay first. So, talking about that snowball effect you were talking about, Ben,
Mm.
wasn't just psychological momentum. It was, to us, it felt like a moral issue. This person had lent us money and we wanted to get it to them first, right? So it wasn't the best financially or mathematically, but it felt the best to do. So that was the one that we did first. But we did exactly this process. We listed them all out and we said, what makes the most sense, all things considered, to pay first, and let's just hammer down on that thing as fast as we can. And that's what we did. And it's absolutely true. There's a psychological high that you get by paying off a loan, and then that does free up cash flow to do even more on the next one, right? And oftentimes, I don't know if you've run into this, but I have. Clients come to me and they show me their listing of debt, and they're paying it all off equally. And I suggest to them that, wait a minute, just make the minimum payment on this one and max it out on this other one that's really high interest. And that can help free money up much quicker than just doing it all equally, or not thinking about it, not thinking about it in terms of just big picture, what makes the most sense. But yeah, anyhow, there you go.
Yeah, and so I think that one kind of doing your own little budgeting and choosing where to pay down things, I think that's a great spot for everyone to start. That's a really good solution to do things with. I think the next step then would be to kind of on your own do a little bit of your own loan consolidation, which is what we've already touched on very briefly here.
Absolutely.
But just
Yeah.
as an example would be, suppose I had $5,000 in credit card debt that I wasn't paying off in every cycle, like, and I'm actually being charged interest on it. And suppose over here, I've got access to a $10,000 line of credit, but I haven't borrowed anything. This one I would be paying 22% on. This one, if I did borrow from it, I might be paying 9 or 10% on. Well, it actually would be a smart decision to borrow $5,000 from my line of credit, go over to pay off the credit card, and then over here work on tackling that debt and start paying it off over time just to lower the overall interest rate. In that moment, I haven't reduced my total debt load at all. I've just transferred 5 grand of debt from here to here, but it does lower that debt burden, lower the interest rate burden moving forward. So
Absolutely.
especially if you're thinking this is like going to take a few months or a few years to get out of, that can have a big impact. If I was planning to pay this off in the next cycle or two, maybe a bit less. But I think that can be a really, really good option for people.
As
A
long as
lot
they
of
put the credit card in the freezer.
yeah, well, and that was actually at the end of this section. I've put this little, asterisk here that that's an important caution is that this kind of thing, you have to analyze what got you into debt in the first place.
Absolutely.
And okay, yeah, now you've moved money over to the line of credit, but what if you just keep spending? What if you just keep racking up more and more and more debt? And so this kind of consolidation on your own, like that's only going to work if your spending habits also change, and you start putting it. And otherwise, you end up with a loan over here, and you still have the credit card, and you're racking on more and more and more debt.
And believe me, I've seen that happen many, many times. I've had people come and show me multiple credit card loans, and it's because they got an introductory offer on something, they transferred money over to it, but they kept the other card and they kept on overspending on it, and now all of a sudden they're owing, on two, and then another one comes along and pretty soon they're trying to, they're borrowing from one to pay to the other over and over and over again. And it, again, it creeps up on you. It doesn't happen all at once, but the second you notice that, you really need to clamp down on your spending one way or another, and deal with it appropriately.
Yeah, well, and that can be an option specifically too with credit cards. It's something I'm very wary of and very wary of recommending. But there's something called a balance transfer that you can often do with your credit card, and so you'll see if you're applying for a new credit card, they'll offer you maybe 12 months of 0% interest
Right.
or a low interest rate if you transfer a balance from another credit card over to it. And so that actually maybe is even better than the line of credit example, but just something I would be extremely wary of. You had racked up this debt before, now you've transferred it and you aren't paying any interest. That's great if you can manage to pay it off down, but I just don't want people to then be in a cycle of, okay, well, now I haven't paid it down. In fact, I've racked up even more credit card debt, and now next year I have to do balance transfer again with a new credit card to move it over. So just
That's
something
right.
you
You
want to
just need to
be,
be super vigilant about paying that down. That's absolutely right.
well, yeah,
Even
and
if,
and
yeah,
and are there transfer fees? And when you do it,
yeah,
when does the interest start accruing? Because it
yeah,
usually will be just a temporary low interest rate.
yeah. Yeah. So if it means not going out to restaurants, if it means cutting off your cable, if it means stopping your streaming services, make it happen. You got to get that paid down.
Yeah, well, and that's what I say too. Like high interest debt, it is an emergency
Yeah,
and should be
that's
dealt
right.
with. So other than that, like I think again, that option, the option before where you just budget and pay things down, pretty much applicable to everyone. Now, as we move on, we get into kind of the more severe cases, or what happens if I look at those options and I say, you know what, I actually still just have too much debt. I don't see how I feasibly can budget and get out of this, even with some do-it-yourself loan consolidation. What are the options then? And so that's where you've got a few options here, starting with just there are some companies out there that make it their business to help with this. Some of them are for-profit companies, others are nonprofits, but they're kind of just debt consolidation companies. And so they can help you essentially negotiate with creditors, usually to get down reduced or zero interest. And the creditors, like the people who have lent you money, they're usually happy to work with these institutions because they'd rather get some of their money back, even at low interest, than have you pursue a bankruptcy and clear all the debt.
Actually, you know what, Ben? There is actually a 2.5 solution.
Ah, okay.
There is one in the middle there that maybe we should just touch on, when I think about it. There, debt consolidation companies are great. Many of them are. You do have to be careful, but there are a few instances where you can try some of this yourself. You may not
Oh, like
get,
directly with the issuer.
yeah, you may not get as far, but for example, actually CRA, if you owe them a bunch of money, they're actually not too bad for this. They they're unlikely to reduce your debt, but there is a good chance that they will waive the interest. We've seen that happen. And so you may not need to go to a third party company to make that happen. There may be some steps in some instances where you can approach the companies that you owe or the organizations that you owe yourself and say, hey, look, I'm having trouble with this. Would you consider lowering the interest rate or whatever it
No,
is?
yeah, that's actually a really good point because a lot of these, well, all of these issuers, they usually want to work with you. They want to get you on a payment plan. They want to
That's
somehow
it.
receive the money
They want
back.
to get paid.
And if you're really struggling, like that's sometimes an option. If you're not, they might tell you to go kick
Exactly.
rocks, but they would rather get paid back some amount of money on some schedule again rather than having you waive the
That's
debt
right.
by pursuing a bankruptcy.
Yeah.
So they
Yeah.
they can be pretty flexible in that route. And then the one that I was talking about is essentially just having someone negotiate that on your behalf. If you've got maybe multiple lenders or things like that, they will do this work on your behalf and reach out and see if they can get those lower. And then typically they'll also consolidated into one monthly payment instead of into multiple over like a fixed repayment period.
Right. Yeah. Yeah. Yeah, and I've seen situations where that's worked really well for people. It's I mean it's close to the last resort. It's not quite the last resort, but it's starting to get there. You don't want to do this if you're not in serious trouble, because it does affect your credit rating. But it can be very valuable, and it's better than the next couple of alternatives that we're going to talk about.
Yeah, well, and so those that we are going to talk about, basically the last two would be a consumer proposal or an actual bankruptcy. Both of these, so they're a little bit more severe. You can't just go through any debt consolidation company or any nonprofit in Canada. It has to specifically be through a licensed insolvency trustee, so an LIT. And basically, they are allowed to put together a legally binding agreement to reduce or, in some cases, eliminate the debt that you actually owe. So these kinds of things, you'll work with the LIT. They will take a look at your income. Like I can't just go and waive 5,000 of debt because I feel like getting a reduced amount or an eliminated amount. You have to actually be truthfully unable to pay it back in a reasonable time period, and they will help you figure out kind of what that is, see if there are other options first, or if there aren't, pursue one of these options. Uh,
But this is going to seriously hit your credit rating.
yeah, yeah. Yeah, so essentially they review your income, your assets, your total debt, and then with the consumer proposal, they make a proposal to your debtors. And for example, it'll say, okay, well, you're only going to have to repay, let's say, 40% of the debt that you owe. And your creditors actually vote on whether or not that's going to go forward. Once again, they'd rather receive 40 cents on the dollar rather than 0 cents on the dollar. And knowing that it's come through a licensed insolvency trust, basically they know that it's a reasonable proposal, not something crazy out to lunch. But then typically, then you're just paying that off again over a fixed monthly payment. So debt is reduced. Usually your interest stops. You're usually keeping all of your assets and stuff like that.
Or most of your assets.
Most of your assets.
Yeah, like they're not gonna less necess in fact, they likely would not let you keep non-registered investments,
Right,
for
like
example,
liquid.
right?
Yeah.
But your RSPs, yeah, they will. Yeah, car, home.
Yeah. Yeah. And so I think those are kind of best for people who, again, they've gotten into too much debt. They can't repay it all, but they can repay some of it. That's kind of an option. And you don't really have to choose which of these you're going to do. If you're at that stage, you should go to a licensed insolvency trustee and you should ask them what to do, and they'll help you figure these out. But
Yeah, that's a good point, right? They're going to help you figure out whether you should go the moderate route, whether you should go this more severe route, or even the next more severe route of bankruptcy. Um, uh, and you know, I think there's a lot of stigma to bankruptcy, and I don't think there should be, frankly. Bankruptcy is there for a reason. Sometimes crap happens, and there's no way out of it. And it might be a disability, it might be a permanent loss of a job, it might even be a swing and a miss at a business. That's typically where we hear about bankruptcies is more in a corporate sense.
mhm.
But each one of those, I mean, I guess if it's a swing and a miss in a business, it's a failure of the business. But that's life. Most businesses fail many times before they actually succeed. And so one shouldn't feel bad about taking that route if you need to, because it's there for a reason. You should never be indebted for all your life. So don't be afraid to explore those options.
Yeah, no, I agree. It's like this is maybe the last resort, but it's still a very legitimate tool to use to get out of bankruptcy. And it's part of the system. Like it's
Exactly.
part of the
Exactly.
system that you used to get into the debt. Well, part of the rules of the landscape are that if you're unable to pay that back, you're able to pursue a bankruptcy and get it waived.
Yeah.
So absolutely a legitimate route and something that can be worthwhile. What it actually does is it's a tool that legally eliminates most of your unsecured debts. So if you had credit card debt, line of credit, personal loan, even debt to the CRA, with some rules there, um, that can all just get waived and stroke of a pen. It's not that easy, but stroke of a pen
Yeah.
and your
Yeah.
debt's gone. Um, and so you might have to, in this case, surrender certain of assets of yours. Because again, like they're not going to let you declare bankruptcy while you still have 100 grand in the bank, for example, right?
Yeah.
Um, you might also have to make income-based payments of any surplus income you have, and then just kind of depends on the situation, but you can be um, kind of paying those for a couple of years for a first bankruptcy. I believe a second and third bankruptcy, the rules are a little bit different. They might be a bit more stringent, but yeah, again, that option you have to go through a licensed insolvency trustee.
Yeah. And again, I mean, one should never feel bad about doing it, but it also shouldn't be the first, don't jump to that. Start with the more simple, softer steps of just figuring out where you're at and trying to pay it off yourself. And if you're having trouble talking to some of the people you owe money to, you know, don't jump the gun and think your only solution is bankruptcy. There's lots of steps in between that you can take, you know. Um, some of the pros of the bankruptcy is it's one of the fastest relief mechanisms. It tends to eliminate most of your debt. Um, you get legal protection from creditors and you get a clean slate. Um, but that clean slate in a way is a clean slate many years down the road because it affects your credit rating. Um, so the clean slate is a debt clean slate and then a credit rating clean slate many years later. So and I guess that is one the big con is it has the largest impact on your
Yeah.
credit
Yeah.
of
Well, it
bankruptcy.
affects your credit rating by completely trashing your
That's
credit
right.
rating,
Yeah.
right?
Yeah.
Like and I believe even after it's paid off, it'll stay on your credit rating for the next 6 or 7 years.
That's right. Yeah.
And then, and just like realistically, think about if you're a lender and you see someone applying for debt and they've had a bankruptcy within the past 5 years, well, that lender is pretty unlikely to issue you a loan, or if they do, it's going to maybe be at worse worse terms, worse interest rates, so on and so
You,
forth.
actually, I think it's worth noting even in a corporate bankruptcy. So, I mean, the idea of if you have a business and it's doing poorly and it goes bankrupt, the idea of that corporation is to protect your personal assets unless you've signed a personal guarantee. So the corporation could go bankrupt and it wouldn't affect your credit rating because you're not the corporation. It's a separate legal entity. But a lot of times, in fact, actually, every single year as an advisor, we have to answer these questionnaires. And one of them is any corporation for which you're a majority owner, has it gone bankrupt, right? So even if your corporation goes bankrupt, it may not affect your credit rating, but there are questions that you may well be asked in other credit situations or other legal situations where you've been involved in that. So it really is. It's a last resort, but sometimes it's the only resort, and you shouldn't feel bad about using it.
Yeah, yeah. So especially for, I mean, who it's best for would be those people with no realistic ability to repay the debt that they've
Right.
gotten into, people with low income, huge debt loads that are really overwhelming. Oftentimes this is after some kind of crisis, something has happened. So, um, Yeah, so those are kind of the options out there. Again, going from less severe to more severe, we had just budgeting and paying it down right off the bat, do it yourself kind of loan consolidation, checking with the creditors to see if they'll help you out in terms of a payment plan, having someone else help you do that, so kind of a debt consolidation company. Then we had a consumer proposal, and then finally a bankruptcy. So that's kind of the gamut of what's out there in terms of options for paying down debt. And again, just to kind of tie it back, sometimes that's not the right idea. Sometimes holding some debt can be an okay idea. Really, it's just that high interest debt that you want to watch out for. I tend to just think about paying debt as a guaranteed return, and the guaranteed return is whatever that interest rate is. So if I can get a guaranteed return of 12% in a year, awesome, I'm going to do it. I'm going to pay down that debt. If I can get a guaranteed return of 4% in a year, maybe I'm not that excited about that. Maybe it's still worthwhile to do, but I might have some other better options.
Well, and if that 4% is tax deductible, it's not really 4%, it's 3%. Or yeah, basically if you take your marginal tax bracket off of that, so for that reason, going back to what I said at the very beginning here, I love debt. Debt has made me rich. It's made many of us rich. Again, mostly just with our house. But anytime you have the opportunity, or you have a good opportunity that's a solid one, and you can borrow money for less than what you're going to earn, that's going to bring you ahead financially. Problem is, frankly, it's kind of, for many people, it's kind of sucky to have debt into retirement. Psychologically, most people don't like that. Like I said, I'm a bit of a unicorn, doesn't bother me, but and I have, uh, maybe 1 or 2% of my clients are like me. They don't mind holding some debt into retirement because they recognize it can be valuable. Most people are not situated, or don't feel good about that. And so, the emotional part is not nothing. It's something that you really want to consider. And so for most of us, we want to be out of debt by the time we're into retirement, because debt brings on stress. So, um, but yeah, so keep that stuff in mind. Uh, debt decisions affect cash flow, they affect taxes, they affect retirement timing.
And vice versa, right? All of those things affect the debt
Yeah,
decisions too, right?
exactly. That's right. That's right. Yeah. So we're here for help. Whether you're working with us or with somebody else, feel free to use the tools we've just talked to you about. But certainly if we can help, we'd love to help you out. Debt can feel like a heavy weight, but the most important thing to remember is you always have options, whether it's tightening up a budget, restructuring what you owe, or getting professional help. The worst move is doing nothing and just hoping the problem fixes itself, because that almost never works. If today's episode helped clarify things or spark questions, that's great. Getting informed is the first step towards gaining control. Thanks for spending your time with us on the Retire in BC podcast. If you found this episode useful, please share it with someone who might need it, and we'll see you next time.
Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.